look at the company. The company is the Boyd Group. They reported last month and then just came out with a new presentation this past week. So the Boyd Group, symbol BYD on the TSX, trades just under $280, about a $6 billion market cap. Yield is just 0.22%. Again, Boyd was originally recommended by Keystone in November of 2008 at $2.30. Today, it hit a new all-time high in the range of about $280. It's up over 12,300%. Importantly, what does this company do? It's one of North America's largest operators of non-franchise collision repair centers. The company operates 130 locations in Canada under the trade names Boyd Auto Body and Glass and Assure Automotive, as well as approximately 800 sites in the US under the Gerber Collision and Glass brand, for a total of over 930 centers as at the last quarter. Let's take a look at the recent quarterly numbers from the business here. As you can see, good growth in terms of revenues, EBITDA, and adjusted EPS. The adjusted EPS line really ramped up in that quarter. That growth rate is not sustainable, but it is a tremendous growth rate we saw there. Let's look at some additional highlights here. Net earnings per share, which we'll look at. Not an adjusted basis, were 95 cents, up from 55 cents in the same period of last year. Debt net of cash before lease liabilities increased from about $316 million to $356 million as at September 30th, 2023. The company also added 21 collision repair shops locations, including 17 through acquisition and 4 are just startup greenfield type locations. Now, subsequent to the end of the quarter, the company added 9 repair locations, including 6 through acquisition and 3 startup locations. They also announced the dividend there. Sorry, let's go back to that. They announced a dividend increase of about 2% to 60 cents per share annualized, up from 55 or 58.8 on an annualized basis. Now, they just released their 2020 investor presentation on January 9th, which had some little nuggets in there that are important for the business currently and going forward. They listed 932 locations at year end versus 898 reported at Q3 2023. That implied 34 new locations in Q4, which is well above consensus estimates. Q4 marked the largest step up in store count since Q3 2021. On a full year basis, Boyd acquired approximately 80 locations in 2023, up from just 23 in the prior year. Of note here, it appears that the consolidation industry, the auto body consolidation industry widely, was down roughly 50% in 2023. The higher cost of financing is impacting M&A, but a strong company like Boyd actually increased its M&A opportunity by roughly 250% from 2022 levels in 2023. So what we believe, this has implications on the company's 5-year growth target. It may get there early. Boyd set a target of doubling its revenue versus 2029 or 2019 revenues by 2025. The current consensus forecast now employs Boyd will nearly reach this target at the end of 2024, with revenue estimates equal to between 90 and 96% of that target versus 2019. Our opinion, one larger multi-shop acquisitions could put the company at the target roughly 1 year in advance. So let's look at where the valuations are right now on an EV to EBITDA basis. Based on 2023 estimates and 2024 estimates respectively, it's about 16 and 13.3 times. They also trade with a PE based on 2023 and 2024 estimates of 54 and 36.7 respectively. Our conclusion here, we believe that 2024 will be another supportive year in terms of M&A for Boyd, and while same-store sales increases tapered from those experienced during the period following the pandemic through 2023, we expect the company can hit or exceed its 10-year average rate in terms of same-store sales of around 6% through 2024, which is a good rate. despite the tremendous gains, we would not bet against Boyd long term and continue to like the business. All right, that's going to end now, and I'm going to stop sharing my screen.
Well, I remember when I was looking at them a couple of years ago and really trying to understand what the future growth opportunity was, because they'd already grown so much, and the question is, are they starting to saturate their market? But they had a lot of runway. I mean, ultimately, what they're doing is they're consolidating auto body repair and glass repair, and they had a tremendous amount of runway. I mean, in spite of the growth that they had achieved in the previous 5 years, they were really just still a speck of the overall sector or industry in North America, which is highly fragmented, like a lot of mom and pop businesses, smaller companies, a few multi-regional operators. So there's certainly a lot of runway for growth there. And then in terms of valuation, not cheap. I mean, 55 times, what was it, this year's earnings, 36 times next year. But if you start extrapolating out 5 years, I mean, if you're really looking long-term on this company, and given its tremendous track record in the past, the valuation actually starts to not look that bad. I mean, it's not it's certainly not a value play. It's a growth stock, but it's not trading, in my opinion, at what I would consider an obscene valuation. I mean, we
No,
see
and it,
100
yeah.
times, 200 times earnings, right? Like, this is a valuation you can still understand if you're looking 5 years out.
Yeah, and any buy right now in Boyd is probably close to fair value near term, but
Mhm.
any buy is 3 to 5 years out. And at the end of this year, they likely come out with a new 5-year plan. I'm not sure if they're going to be able to double operations again over the next 5 years, but the growth rate should exceed the market growth rate. And by the end of this year, you're starting to buy it at a more reasonable price. And if you're again betting against this management team's process, I think you're foolhardy. And they do have that run of growth potential ahead of them, which is still quite large. The other things that could help them, a recession can actually help this business. So it hedges you a bit. Technicians, just getting a good supply of good technicians has been a big issue for this company. It's starting to allay a little bit. But if there's a recession, they actually, just regular workers that work there, but the technicians, they likely, the wage inflation isn't as high then, but also they'll have more supply of them, so it can benefit them. Plus, in a recession, the prices they're paying for businesses come down, and people tend to fix their cars. To get from A to B, you need to get your car fixed, and that's why it's been a beautiful business for a long term. And over the next 3 to 5 years, I wouldn't bet against the way this company has been run.
On that note, I actually have to take my car to Auto Boyd in the next little bit here for
I know.
a glass chip.
I
So
One of the biggest line items in the last quarter when I look at the household is the friggin' vehicle, right? So yeah, it's there's a good buck to be made in that business if you do it right. And Boyd, has a track record and a history of being a good repair shop. I've taken my vehicles there in the past, and it's been a simple process, but they certainly dinged my wallet, and you can see why you want to invest in that, because you're fighting against it if you're not when it's part of a huge household expense.